Why is it necessary for us to buy things from Djibouti and pay in dollars? Why? There's no reason.
We have noted that there is global momentum for the use of local currencies, alternative financial arrangements, and alternative payment systems. As BRICS, we are ready to explore opportunities for improving the stability, reliability, and fairness of the global financial architecture. In this regard, BRICS leaders have tasked their finance ministers and central bank governors, as appropriate, to consider the issue of local currencies, payment instruments, and platforms, and to report back to the BRICS leaders by the next summit.
Africa's push for local currency payment systems is finally making gains. The goal is to bring less costly trade to a continent long impacted by dollar transactions. It's creating payment systems that do not rely on the greenback and mirrors a push by China to develop financial systems independent of Western institutions.
Donald Trump just threatened 100% tariffs on any country that tries to replace the US dollar. But here's the problem. 3 African nations are already full members of BRICS. Nigeria just became a partner country in January 2025, and together they're sitting on some of the world's richest gold and resource reserves while actively working to ditch the dollar.
The nations have found a way to trade in local currencies, which would reduce their dependency on the US dollar.
So the dollar's power in Africa has declined. And this is because the common market for Eastern and South Africa has recently launched a digital retail payment platform.
For decades, the US dollar sat at the center of global trade. Now that position is being quietly tested. South Africa is signaling a move away from dollar-centric trade, deepening transactions within the BRICS bloc and expanding non-dollar settlement routes. It's not a declaration, it's not a headline-grabbing break, but it's enough to get Washington's attention. Because when a G20 economy begins adjusting how it trades, it's not just a currency story, it's a signal. And across global markets, those signals are starting to add up. There was no dramatic press conference, no official statement declaring the end of the dollar era, no emergency market halt. Instead, the shift unfolded the way many structural changes do, quietly, through policy signals, trade agreements, and changing settlement practices that only become obvious after they've already started reshaping behavior. South Africa's move away from exclusive reliance on the US dollar didn't arrive as a rupture, it arrived as a recalibration, and that distinction matters. For years, global trade, especially commodity trade, has been overwhelmingly denominated in dollars. This wasn't just tradition. It was infrastructure. Pricing, settlement systems, reserves, and risk management were all built around the assumption that the dollar was the default. But assumptions only hold as long as incentives do. As global trade patterns evolved, so did the pressures on countries like South Africa, resource-rich, trade-dependent, and increasingly integrated with non-Western partners. Over time, the question stopped being ideological and became practical. Why should all trade run through one currency, especially when trading partners are willing, and sometimes eager, to use alternatives? Within BRICS, that question gained traction. BRICS was never designed as a formal alliance with a single currency or unified policy. It was and remains a loose grouping of large emerging economies with overlapping interests and very different systems. What connected them wasn't ideology, but scale and a shared exposure to dollar-based trade risks. For South Africa, participation in BRICS opened options, not mandates, not obligations, options. Trade settlements began to diversify. Bilateral agreements expanded the use of local currencies in specific transactions. Financial institutions explored alternative clearing mechanisms. None of this meant abandoning the dollar, but it did mean reducing dependence on it. That nuance is where the story gets misunderstood. This isn't about replacing the dollar overnight, it's about reducing vulnerability. Over the past decade, global markets have learned a hard lesson. Currency dependence carries geopolitical risk. Sanctions, financial restrictions, and policy shifts often far removed from the actual trade in question can ripple through economies that rely too heavily on one system. South Africa watched those ripples closely. As a major exporter of minerals, metals, and industrial inputs, it's at the intersection of global supply chains. Any disruption in settlement, financing, or currency access can translate directly into lost revenue and increased costs. Diversification in that context isn't defiance, it's risk management. The BRICS framework made that diversification easier. By expanding trade with partners willing to transact outside the dollar, whether through local currencies or alternative settlement arrangements, South Africa gained flexibility. Deals could be structured to match trade realities rather than default assumptions. This wasn't a retreat from global markets, it was deeper engagement on revised terms. From Washington's perspective, that's where the concern emerges. The dollar's power doesn't come from declarations, it comes from usage. Every trade settled in dollars reinforces its centrality. Every trade settled outside it, even partially, introduces competition. Individually, these moves look small. Collectively, they form a pattern. When one economy experiments with non-dollar trade, markets observe. When several do it within a major economic grouping, institutions begin adapting. Over time, what was once exceptional becomes acceptable and then routine. That's the long game. South Africa's actions don't threaten the dollar's dominance tomorrow, but they do contribute to a world where dominance is no longer unquestioned. And that's why the reaction matters. In Washington, the concern isn't panic, it's precedent. If emerging economies find ways to trade efficiently outside dollar-centric systems, leverage shifts, not dramatically, not immediately, but gradually. The dollar remains the world's primary reserve currency. It still dominates global trade. But the direction of travel, however slow, is what draws attention. For South Africa, the benefits are tangible. Reduced currency conversion costs, greater autonomy in trade negotiations, more resilience against external shocks. For BRICS as a whole, the message is clear. Alternatives don't need to replace the system to influence it, they just need to exist and function. That's why this shift feels subtle but significant. It's not about confrontation. It's not about alignment against anyone. It's about optionality, and optionality is power. As global trade becomes more fragmented, split across regions, blocks, and parallel systems, countries that can navigate multiple frameworks gain leverage. South Africa is positioning itself within that reality. The shock in Washington isn't about what has already happened, it's about what could follow. Because if currency diversification continues quietly, pragmatically, transaction by transaction, the architecture of global trade begins to look less centralized than it once did. And once that architecture changes, restoring the old defaults becomes difficult. In the next act, we'll examine how this shift fits into a broader BRICS strategy, how markets are responding behind the scenes, and why the real consequences of currency diversification are felt years, not weeks, after the first signals appear. To understand why Washington is paying attention, you have to look beyond speeches and headlines and focus on mechanics. Trade power doesn't shift because of announcements. It shifts because systems change. And inside BRICS, those systems are slowly being re-engineered. For years, BRICS functioned more as a political label than a unified economic machine. Its members traded with each other, but mostly through the same dollar-based infrastructure that dominated global commerce. Even when two BRICS nations did business, settlement often ran through U.S. banks, U.S. clearing systems, and dollar-denominated contracts. That structure wasn't ideological. It was convenient. The dollar system was liquid, trusted, and efficient. Using it reduced friction. But convenience comes with dependency, and over time, that dependency began to look like exposure. The turning point wasn't a single event, it was accumulation. Sanctions regimes expanded globally, financial restrictions became a standard policy tool, currency volatility increased, and trade disputes showed how quickly access to financial infrastructure could become politicized. Inside BRICS, that reality forced a reassessment. The question wasn't whether to replace the dollar, it was how to reduce single-point risk, and that's where trade mechanics began to evolve. The first shift wasn't currency, it was settlement. Bilateral trade agreements within BRICS increasingly included provisions allowing transactions to be settled in local currencies. This didn't eliminate dollar use, but it reduced automatic reliance on it. Instead of defaulting $2, parties could choose alternatives when it made economic sense. This flexibility mattered. Local currency settlement reduces conversion costs. It limits exposure to sudden exchange rate swings tied to external monetary policy, and it allows trade to continue even when dollar liquidity tightens globally. For South Africa, this meant being able to structure trade in ways that reflected its actual commercial relationships, not inherited defaults. The second shift involved financial infrastructure. BRICS countries began strengthening domestic payment systems and linking them regionally. Alternative messaging platforms, regional clearing arrangements, and expanded use of development banks reduced reliance on Western-dominated financial channels. Again, this wasn't about isolation, it was about redundancy. In modern trade, redundancy equals resilience. When one pathway becomes uncertain, having another available changes negotiating power. It allows countries to transact without interruption and without drawing attention. That subtlety is key. BRICS trade mechanics aren't designed to confront the existing system head-on. They're designed to coexist with it while quietly reducing dependence on its most sensitive nodes. The third evolution involved trade financing. Historically, trade finance has been one of the dollar's strongest anchors. Letters of credit, insurance, and settlement guarantees are deeply integrated into dollar-based banking. BRICS institutions began expanding alternative financing options through regional banks and multilateral development institutions. This didn't replace Western banks, it supplemented them, and supplementation is enough to shift behavior. When exporters know financing exists outside a single framework, risk calculations change. Deals that once stalled due to dollar constraints could move forward through alternative channels. Over time, that builds confidence. Confidence leads to repetition. Repetition leads to normalization, and normalization is where power quietly shifts. Another critical evolution occurred in pricing behavior. Some commodity trades within BRICS began experimenting with pricing formulas tied to non-dollar benchmarks or basket references. These weren't radical departures, but they introduced optionality. If dollar volatility increased, contracts had flexibility. This matters more than it sounds. Pricing conventions shape expectations. Once buyers and sellers accept alternatives as workable, the psychological barrier to non-dollar trade lowers. That's how systems evolve, not through declarations, but through acceptance. For South Africa, these shifts aligned with existing priorities. As a major exporter of minerals and industrial inputs, it benefits from predictable settlement, stable financing, and diversified currency exposure. BRICS mechanisms offered that without forcing alignment against any specific partner. This is often misunderstood. South Africa isn't abandoning Western markets, it isn't rejecting the dollar, it isn't choosing sides, it's choosing options. From Washington's perspective, that choice matters. The dollar's influence is cumulative. It depends on habit, on inertia, on the assumption that alternatives are inconvenient or risky. BRICS trade mechanics challenge that assumption not by overthrowing it, but by proving it's no longer exclusive. Once exclusivity erodes, leverage softens. What worries policymakers isn't today's transaction volume, its trajectory. If BRICS trade mechanisms continue to mature, becoming cheaper, faster, and more predictable, usage will increase organically, no pressure required, no political messaging needed. Markets follow efficiency. And efficiency doesn't carry flags. The final piece of the evolution involves coordination, not centralization, but alignment. BRICS isn't building a single trade system, it's building compatibility. Members are ensuring their systems can interact, settle, and finance trade without unnecessary friction. This approach avoids the biggest risk of alternatives: fragmentation. Instead of replacing one dominant system with another rigid one, BRICS is experimenting with modularity. Multiple currencies, multiple platforms, multiple financing routes. That flexibility is harder to attack and harder to reverse. For Washington, the challenge is structural. You can respond to policies, you can respond to sanctions. But how do you respond to optionality? Once trade mechanics diversify, reversing them requires making the old system unquestionably superior again, not just dominant by tradition. That's a much higher bar. The dollar still dominates global trade. Nothing in BRICS mechanics changes that overnight. But dominance doesn't erode suddenly, it erodes incrementally, one bilateral deal at a time, one settlement choice at a time, one financing decision at a time. That's why South Africa's move resonates beyond its borders. It signals that participation in alternative trade mechanics is no longer theoretical. It's practical, it's functional, and it's increasingly normalized. The real shift isn't about replacing systems, it's about ending dependence on just one, and in global trade, ending dependence is often the first step toward redefining power.